financial analysis in the 1930s was primarily about bonds, and is company able to pay back debt or not. And the first person probably who looked from credit perspective, started valuing equity, was Benjamin Graham. And that was about finding the value in equities based on quantitative characteristics which before we used to value bonds. So that was from credit to equity. Usually we talk about E to C, from equity to credit. But actually historically, the expertise came from credit to equity. Then was Merton and credit grades after that, and KMV model and so on. Why these models appeared? They not appeared because it was intellectually fascinating. It's because people had to measure and report risks on credit which we had no idea how to do. So that's why you need to look at how assets of the company move, think about the underlying process, and try to come up with a number which sort of makes sense to estimate the credit quality of the name. Yeah? Then we go forward around, 15 years. And mid-90s, banks started using these models actively to mark their illiquid credits. Not to hedge illiquid credits, although later, a little bit later, we will be hedging illiquid credits as well. Then guys who actively started trading that equity were actually convert guys. Why? Because convert has an intrinsic put, yeah, which convert is short through the corporate bond, and upside volatility, so upside call, which is long. So therefore, convert bond is effectively like a risk reversal. And convert guys very early realized that real delta on a convert bond is not the delta or spot sensitivity of the upside call, but actually there is a little bit of delta coming from the corporate bond as well. That's why we develop models, first empiric and after that more scientific, how to think about this delta. And later, the same convert guys started trading capital structure arbitrage, and then it appeared as a standalone strategy, which all of us traded at some point. And then it came to macro level, and now from the previous panel we hear how you can think about macro level, analyzing very large moves in benchmarks of asset classes. So today, what we're trying to do, we're trying not to sell any particular product and not trying to explain exactly how to make money with any particular one, but sort of go back to basics and think a little bit about the logic and what's the background of this connection. First of all, we're going to show that there is a connection. Then we're going to talk about what was the historical development, what's so-called the structural models which link credit to equity. And then, a little bit later, talk about no arbitrage model or market models, which I developed 10 years ago, and which we use on a macro level to hedge loan books, to hedge convertible bond exposure for large banks, and which you might find interesting to think at least for your own business. So what we do first, Alex will start and talk about empirical evidence. We'll talk about a Merton model, and we'll talk about trading strategies which you can think and develop based on the statistical analysis of joint distribution.
Everyone from my side, from the credit angle, knows that to hedge out their books, they're going to need some sort of an S&P put or an upside VIX structure. The question is, not very many people know how many, how much. And what we're trying to do is to draw the lessons from the credit to equity dynamics that we explored over the last 12 years, and try to draw some conclusions that are actual today. So these charts, we're basically plotting aggregates of CDSs versus VIX, or aggregates of investment grade CDS versus short-term skew. There is empirical evidence linking up credit to equity volatility. The concept that I am a European asset manager trading high yield and VIX, which is a volatility index for US stocks, is relevant to me, was definitely alien in the past. But the need for a liquid edge and more importantly, the avoidance of counterparty risk really imposes on credit managers these days to become cross-asset traders. Why, though, do we look at vol? What is the link? And the answer is provided by the Merton model. For people who haven't seen it before, this can be quite tricky to explain, so I'm going to try to do the best I can. Looking at a stylized balance sheet, you have on one side of on the side of the balance sheet you have assets, then you have debt and equity. So looking at the world from an equity holder, essentially your debt is fixed because that's what the companies use to fund themselves. So in order for you to generate a profit, you would have to have the assets of the firm expand. So the payout profile of an equity holder within the Merton model is extremely similar to the one of a long call. So essentially Merton defines equity holders as essentially longer call on the net assets of a firm. Conversely, when you look at it from a debt holder perspective, you have a known upside, but your risk is default. That is very similar to being short to put to the company. When does default occur? Default occurs within Merton models when essentially the assets of the firms go beyond the level of the debt of the firm, i.e. equity goes to zero and the company goes in receivership, you receive your recovery value, in your worst case scenario, your payoff would be zero. So the Merton poses a selfish problem. We know the assets and liabilities of a company, which is at this point a viable company. How do we ascertain its creditworthiness? The answer lies in option theory, and in its simplest form to explain is essentially you model stochastically the value of the assets of the firm, and default occurs when you hit the barrier, i.e. the default point. Both are stochastic variables. In reality, what it means that when you cross a certain value in terms of the asset, your company goes in default. It's clear to understand here the link between volatility and credit. When you think that the asset value, the more volatile the asset value, there is a higher likelihood that you would hit the barrier. So here's the link that is established between credit and volatility. Generally, the assumption is that higher vol regime affect pretty much everywhere in the world as a consequence of event risk. You have three major ingredients: the asset value of the firm, the volatility of the asset value, and the default barrier. Credit grades, as Kirill was mentioned, and KMV in the past have tried to adopt the Merton model verbatim to current balance sheets, so analyzing different aspects of the capital structure. They provide us with a link. The advantages is that they provide us with a link between credit and equity. The disadvantage is that so far I've been talking about asset value. I mean, what is the asset value of a firm and what is the perceived asset value are two completely different things in reality. So we're not dealing within this kind of model, which has defined the structural models, with tangible variables in the market. So here enter reduced form models. Essentially, these models tends to, in one way or another, alterate Black-Scholes to allow for a jump to default and create, through observable variables, a model that is very similar to the Merton concept. This is just a little bit of history. There is plenty of criticism brought to the Merton model. I'm going to skip through this slide very quickly. The important thing to understand is that Merton in itself, for whatever fault it might have, is giving us a framework, is asked the question, is giving us somewhat of a lead into the answer. It was never intended to be a model a trading model, and it was not intended to be, it was essentially intended to be something that would give you a fair value, an assessment of your loan book, an assessment of where the credit worthiness of a firm, but no guarantee that within the life of a bond or within the life of your debt, this divergence, if one, is there. Obviously, with history and with this type of models, people ended up trading, as Kirill was saying, 2003, capital structure was the buzzword, the Morgan Stanley withdrew a lot of money at it. It was a relatively volatile environment as well for it. But ultimately, to move from the model to, if you want, either a trading system or a signal, we now have to create, so we have to create our own steps. So there are three essential components in your credit to equity models. The first one seems trivial, but you need to choose an asset. You need to choose an asset class. What are you trying to hedge? Is it a single name, a bunch of loans, an individual CDS, which is a synthetic put on bonds? Or are you trying to give a macro hedge to a credit book? This is key because it will determine the path that you can take. Level 3 and 4 on this chart essentially are giving you a framework within which you can analyze where you are right now compared to history, you can analyze where you are compared to the leverage and the embedded riskiness of a company. So essentially your model has to have some sort of relevance. As of today, because it's a relative value model, one variable would be undervalued compared to another, and you need to understand the relationship with these variables through history. And last, but not least at all, is the fact that all these models really deal with assumptions that are non-realistic, like no trading costs, no infinite liquidity within the system. So it's very important that once you choose how to, which approach to take in analyzing your credit to equity trading, is that you have on the other side a methodology to size up your trades. I'm going to be talking. Sorry, I'm going to be discussing aggregates because that within aggregates you're pretty much bound to deal with it from a statistical point of view rather than from a theoretical point of view. Of course, the intuition behind the model is there, whether you're dealing with VIX and high yield as when you're dealing with a single company. So what is important to understand is that credit spreads do not link themselves to the level of equity when we're talking about aggregates. So S&P is not going to jump to zero. An index of CDSs is not going to default because as components default, they get replaced. So essentially you have this continuity that you need to extrapolate. One elegant and extremely simple way of analyzing this relationship is through a linear regression, where essentially you're trying to do is establishing a link through history, through through an equation. Identify the components of this equation, and ideally you plug in the number for the VIX. In this case, we are regressing IG index versus VIX. And you plug in the number of the VIX, and that should give you a level for the CDS index that you're looking for. You compare that to the market, and you can kind of understand how far off historical standards you've been. There are various tests for the validity. If you're new to this, the one that I will be pointing out to is obviously the R-squared. That tends to explain the relationship of one variable versus the other. An R-squared of 1 will be explaining 100% the movement on one variable versus the other. So what you're looking for is a high R-squared. It's very simple. Bloomberg, fortunately, has given us, you don't even need a statistical model anymore. You can run this type of approach through Bloomberg. What is the problem with it? The problem is, as you can see in the red line or the blue line, there is a huge amount of variability when it comes to the relationships through time. So it's generally a longer time frame. It has more relevance than a shorter time frame. And if you're familiar with in-sample and out-of-sample methodology, basically what you're trying to do is you're trying to establish this relationship over a multitude of time frame in order to apply to the current trading regime. The alternative to, so the diffusion model generally works for broad relationship. A simple mean reversion model essentially aims at doing just the opposite. So it aims at looking at the dislocation between credit and equity within its localized volatility. In very simple terms, there is we assume that there is a mean reversion strategy, and we can test for it later. But so essentially you ratio the two variables. You have to choose a time frame. In this particular case, we are regressing. I think it's main versus VIX. You create an average, which could be, in this case, is 30 days. Ideally, the closer it is to your trading horizon, the better it is. And on top of it, you generate an envelope of 2 to 2.5 standard deviations. The model is very simple. When you hit when you hit one of the envelopes, you put the trade. So if you hit the yellow envelope, you will be shorting the ratio. It converges back to average. You go flat. Now, this is an extremely simple methodology and approach, and the only way to test for it is really through a qualitative statistics. How much you're in the market. So you're trying to minimize the amount of time you're in the market. What number? What is the frequency of your trades? But more importantly, to verify mean reversion, do you have a similar number of trades on the long side and on the short side? Obviously, success rate, return, these are all to somewhat size your appetite for the trade, and they're much more relevant when you're comparing different time frames vis-a-vis just looking at a number. Wait, 590, I wish that would have been a good one. And then you look at the average return for trades. You're looking at the average length of the trade, which is also extremely important. You don't want to, you generally want the trade to last a fraction of your time period. The closer you converge to it, the more wrong you can assume that your mean reversion is working. So we said that in terms of the regression analysis, that works for long-term averages. It works for establishing a relationship over the long period, but misses probably quick adjustments through time. The mean reversion model essentially deals only with quick adjustments through time. And this is a methodology that I've applied both to statistical methods and to theoretical methods. So essentially, what you will have is that if you have a longer time frame of analysis, your model will have a bias. It will either spit out numbers that are way above the current market level, hence indicating, if you want, a fake signal, or below, essentially. So in order to avoid this model bias, we do what is called marked model. You regress you use linear regression to establish, or any other statistical model to establish a relationship with your variable. You then apply this relationship to calculate a theoretical framework and a theoretical envelope using what we just saw in terms of mean reversion. So you overlay actual market values over theoretical values and check again for the statistical relevance of these methodologies. Both these methodologies are very effective and extremely simple to implement. The trick is that, as Kirill was mentioning, the relationship between credit and equity is spotty and changes over time. So you really need a multitude of signals before you actually implement the trade. So we sort of have so we picked an asset and we've looked at one of the ways you can use to decode current market level versus where things have been historically. But what we need to now ascertain is essentially how do you size your trade? What is the amount of sensitivity you need of one variable versus another? Regression analysis comes again into question. Bloomberg helps us with these functions. And essentially, what we're looking at is now, it's remarkably similar to the previous chart, but in essence, it changes right here. So we are trying to regress now the rate of change of the variables. The rate of change of the variables should give us a relatively more stable a more stable relationship through time. Why? Because effectively you don't want your hedge ratio to change through time. So in this particular case, when regressing high yield versus VIX, your relationship between credit sensitivity and Vega is about 10-to-1. So we were talking about, we now have an idea of the kind of size that we need to do, but again, we're dealing with aggregates. And Merton model instead is telling us that there is a jump to default, and as bondholders, we short a bunch of puts. So how do we then size and structure our trade? Clearly, borrowing again from a very simple relationship, if you were to trade a single bond, your biggest risk is your jump to default. So one of the simplest equations that you can have is the return on default versus the return on your puts should equate each other. In other words, the level of credit should give you the lower boundary price for any put trade. The formula is here. The formula is here at the bottom, which basically indicates to you that it's just simply derived by equating the returns of the two strategies. But when dealing with indices, we said there is no jump to default, so we need to sort of coincide the Merton methodology with a more realistic approach. And one way to look at it is essentially regress your, or rather run your credit trades, equating the Vega sensitivity to the dispersion, the regression analysis that we've done before, by using risk reversals. Risk reversals are extremely powerful. As you can see from this chart, we're plotting the high yield through time through 2008. We are looking at basically doing the risk reversal without delta hedge. And then we look at the risk reversal, the blue line, using a delta hedge. So essentially what we're saying is that one approach that can be taken, which is consistent with Merton methodology, which is consistent statistically with our finding, is that we could really have a strategy that would be long gamma on the downside, financing it with selling some on the upside. The question here is why? I mean, is there any theoretical validation? We have deducted this from empirical evidence. And on that, I'm going to give you Kirill to enlighten us with this model.
So basically, what was the story? In 2002, end of 2002, beginning of 2003, I moved from equity derivatives and GP to convert desk. And converts were very strange at the time because there was zero issuance. 2002 was difficult for converts. And effectively, the whole convert book was a corporate bonds book. And we're supposed to hedge it. And hedge was extremely expensive. So my job was to find a way to hedge global convert book without spending much money on it. And one of the ways to do it, and it's exactly how guys actually did it before, was a Merton model. So let's assume we have a CDS, which we don't. And let's try to dynamically hedge with CDS, thinking about it as some sort of downside put. There is a little bit of delta. On investment grade names, it's a very small delta, 5–10%. So shares move up and down. CDS effectively does nothing. You lose money on trading gamma, and nothing happens. And also internally, deeply inside, you understand that if really there is a default tomorrow, and it's an event, and it's overnight, then your 5% delta or 10% delta not going to cover your CDS. So you pretend you're hedging. Risk management pretend they understand that you pretend. And that's how it was. So my job was effectively to find a way not to rely on the model much and actually cover jump to default. And as always, I mean, my previous life in academia, I studied non-equilibrium pricing. So effectively, when there is an arbitrage and how quickly arbitrage disappears and so on and so on. But basically, what it forced me to think, and we're still trading the same way now on the level of the whole firm. Model exists if you can enforce it. Exactly like Alex said, you can look at the Merton and you can think how Merton price is too high comparing or too low comparing with the CDS, but what you do after that? I mean, you can buy or sell CDS, and effectively all type capital structure trades were effectively long or short credit trades when you have an excuse to hedge. Yeah? So what we done, we started thinking how you can build a model which is a real arbitrage model, where you can build a hedge dynamical on the other side, which if CDS is not in line with the future expected cost of hedge according to the strategy, then you have an enforceable strategy. Then you sell one, buy another, and then either CDS or equity options will correct to the mean, or you sit till expiry and collect the arbitrage return through the difference of the carries. So very Black-Scholes type idea. If you remember slide, this one. That's actually standard put CDS ARB construction. Yeah, so you sell CDS, you buy downside put, you make some assumptions on recovery. Usually when people put with trade zone, they sort of want to be long risk, so therefore they sell CDS or they buy bonds and buy with downside puts as an excuse to hedge. They make assumptions on recovery. In stress, recovery assumptions low, and good market environment, recovery assumptions high. That also creates a bias on how capital structure ARB trades run. But basically what you see here is very much Merton's idea. Yes, so CDS is a deep downside put. So therefore, in equity to hedge, you need to buy deep downside put. What's the problem with that? If you really go to single stock desk and start asking prices for deep downside puts, what's going to happen? They know what you're trying to do. Yeah, and if 10 years ago it was sort of still possible, now it's considerably more difficult because everybody knows about it and everybody tracking the same things. But also, trading single stocks are extremely expensive. Yeah, and you cannot really do it in size, especially for deep downside. Closer to the money you can, but deep down with low strikes, when you need to build the size to really cover jump to default, it's difficult, expensive, execution-wise, in, out. So now, what you need to do, you need to buy closer at the money puts. If you're buying closer to the money puts, what's happening? They are extremely expensive if you don't delta hedge them. Yeah, because you long the jump, but also you long this gamma which you have and you're not using. You can start delta hedging, but then you're cutting what these puts create for you in terms of the protection for the jump. Which basically tells you that CDS hedge needs to be with zero gamma. And another way to think about it, suppose you have a CDS position and you have this put, and spot moves up 5% and then down 5%. CDS does nothing, but on equity side, for hedging, you already spend money to hedge it. So therefore, it's a mismatch in terms of the cash flows. So you need to have zero gamma. You just bought downside puts. You're not going to sell downside puts because they're expensive and you like to have them. So what you're going to do, you're going to sell upside gamma. That's the whole idea behind the risk reversal stuff. So you're buying, what's that? You're buying this downside put and you're selling this calls. And you're doing it in such a way that around where you are, your gamma is zero. So now let's think what this very intuitive construction already telling you. What it's telling you is that if there is no skew, then CDS should cost zero. In sort of simple Black-Scholes type world where there is this Black-Scholes dynamics with stochastic volatility and so on, and there is a single jump to default and it's a game over. So what's happening? Let's create in zero skew environment what people call symmetrical risk reversal. That's a risk reversal which 30 years ago, 25 years ago, people in FX used to hedge barrier options. Yeah, so it's not something we read books before we started trading. So symmetrical risk reversal, how it works? You take risk reversal where product of strikes is equal to forward square, and the ratio of notionals is proportional to ratio of square root of strikes. What this symmetrical risk reversal does for you in zero skew environment, it has zero gamma, zero vega, and zero theta. So in that sense, it's a true generalization of forward. What's interesting about it, that if you put forward hedge on top or delta hedge on top, then the whole combination around at the money will have zero gamma, zero delta, zero vega, zero theta. So cost you nothing to have. But if there is a jump, then you're making money on the jump. Because on the delta, you're losing less than you're making on the big size of its downside put. So that's the positive gamma which we're effectively accumulating for free. Now, clearly spot moves a little bit, so you need to roll the structure. When you roll the structure, what are your costs for rolls? Delta? No, delta is zero. So on delta, you didn't lose any money. On gamma, you didn't lose any money. On vega, if volatility moves up and down, you don't lose any money because vega is zero. So now, theoretically, trading and rolling with credit risk reversal costs you nothing. So you sell CDS for whatever, 15 bips, doesn't matter for how much you sell. And you put this risk reversal in place, and it costs you zero. And you roll it for free. And if there is a jump, then you're covering exactly the downside on the CDS. So this dynamical trading of the risk reversal, it's in the Black-Scholes world, if you like, that's analog of trading delta. It's just delta in this case is not forward as for standard options, but the risk reversal, this symmetrical risk reversal, which is a generalization of a forward. Yeah? So now what we see that in zero skew environment, we build no arbitrage model for pricing CDS. Yeah? We trading with risk reversal, maintaining jump, covering exactly the jump to default on CDS, and that's it. So now what I need to do, I need to start selling CDSs and buying this risk reversal, and that's my arbitrage return. What's happening now? You're buying with puts, you're selling calls. So effectively you're pushing price of puts up, price of calls down. Yeah? You're creating the skew if you start hedging. And you still will be doing it for as long as the price of your hedge, this dynamical hedge through risk reversals, will be less than cost of carry which you're bringing from the selling credit protection. So what you see here is that first CDS will be price of CDS or spread or upfront CDS will be proportional to skew. Yeah? If there is no skew, CDS should cost 0, and that's the arbitrage. Effectively, it's the arbitrage result. Vega, yeah, and we exactly what Alex showed, how CDS moves together with this wall. Vega sensitivity of CDS will be proportional to skew. No skew, no sensitivity. If we move to more interesting world where there is already skew in the market, then symmetrical risk reversal will not be the ideal hedge as before. So what you need to do, you need to change a little bit symmetrical risk reversal, and that's what we call credit risk reversal. That's a generalization of symmetrical risk reversal in case of non-zero skew. What it gives you effectively 0 gamma, 0 theta, but non-zero vega. And that's the effect of existence of skew in Black-Scholes world. And when you roll now, what's happening? Gamma, delta 0, there is a realized skew which is like third momentum, how price moves, but usually it's very small and can be positive, can be negative. Actually quite often it's positive, so opposite what we think. But the Vega PNL, because of the Vega sensitivity of a residual credit risk reversal, actually will be accumulating during the life. And although it's a sort of difficult formula, what you need to see here is only this term. That's a numerical factor. But this term, which is a product of skew in that particular maturity, times that the money vol on that particular maturity, times time to expiry. This term will give you the main component of CDS tracking with respect to single stock skew and vol. And what's interesting is that if, as an indices, skew actually flattening with time, and usually it's almost approximately square root of time, diminishing with square root of time. If you do that and you put it here, you see that veganess of CDS is actually proportional to square root of time till expiry, exactly how you expect it to be for equity options, for downside options. So what we're going to, first thing we're going to remember, that this thing we will be putting on top of CDSs. Single name CDSs, index CDSs, we will talk about indices slightly later. What's important, it actually, this one works on single names as well. So what we done first, when we were young, we tried to see if now we have a model and we believe in the model, can we trade the model? Because if we cannot trade the model and PNL is not looking nice, then it's a wrong model. Because realistically, only trading PNL is the measure of how good the model is. And what it tells you is that, first of all, the model works for financials. Yeah? Merton model doesn't work for financials because financials borrow a lot and lend a lot and huge leverage and basically does not exist. Plus, exactly, yeah. So it works for financials. And it also works for very different sectors and also across the globe. So at the time we looked specifically at US and we looked specifically at Europe and we looked at Japan. What also interesting about it is that actually, depending on the liquidity on the market, it takes longer, it creates bigger gap first of all, arbitrage gap with a lower liquidity, and it disappears quicker in the liquid markets. So therefore, US markets at the time were more interesting for us in terms of the single name trades, single name cap structure trades. It's almost, make me blush to say it's a cap structure trade, because realistically I did not analyze the company at all. Usually how cap structure trades works, you look at the balance sheet, you think a lot, you go to credit analyst, you know the company. Here you don't need to know the company. That's a lie, but you can think that you don't need to know the company. I did not bother to think about structure of the debt. I did not know much about revenues and margin and EBITDA margin and so on and so on. It's a pure ARP model. So there is one set of market parameters, another set of market parameters, and I don't know which one is priced correctly, or maybe they both priced incorrectly. I only care how they priced against each other. That's it. It's an ARP model. And ARP models work better, quicker, and mean revert faster, and require different money management than in the liquid markets. That's why US was interesting, and trading US stocks was cheaper as well. However, no, okay, so suppose you're running capital structure book. How much in single name in terms of options and CDS? And CDS are more liquid than single stock options. What's the size typically you can do? No, 10, 20 mil. Yeah? So how many trades you can find a year? No, maybe 20 trades. In investment grade, what's your upside? No, 50 bips. Yeah? And it's already a lot of P&L. So what's happening? Here you can make 10 mil. You will require 3 guys. You will make 10 mil. It's an interesting proposition, but realistically it's not scalable. So what you need to do? You need to make it scalable. You need to make it interesting. Because we started the journey not to trade in 10 mil size and make 10 mil in prop money. We started to find the hedge for convert book and then loan book of our bank and loan books of other banks, where you need to trade in billions. So what you need to do? You need to move away from trading single stock options. Yeah, and here we're coming back to what Alex called aggregates. And we found interesting way to do it, and as a byproduct, we also find feature which allowed us to create free credit put. And we will talk a little bit about this free credit put. So let's imagine the following. I come to you and I ask, so what are your main jump to default exposures? And you give me 20 names with 50 mil each or whatever, 50 names, doesn't matter. I will split them across the continents, across the indices. So this one will be sort of closer to S&P, this one will be closer to FTSE, this one will be closer to DAX, CAC, or Eurostoxx, because we intersect. And I will build mentally on a piece of paper this capital structure ARP trades, yeah, on a spreadsheet without actually doing anything. And then I put aside all the single name CDSs, and that's the CDSs which I'm going to trade. And on the other side, I will do mental dispersion. So I will take all the single name positions, I will size them in such a way that there is a high correlation to that particular index which I'm going to trade against the portion. And I will try to increase the correlation between my names with the proper sizes as much as possible, to 90. Usually we use 90% correlation to start with. What's happening now? Suppose you look at AX, and you had a hold, and it's 2003. What's happening? Yeah, it's AX 2003. There is a fraud. Yeah, effectively, US operations, difficulty, a hold dropped, became stressed name. What's happening with the index? Index dropped down. How much? I think 4%, something like 3-4%. You flat gamma, you flat delta, you did not see it really. What's happening now? It's either name will recover, yeah, or name will be dropped out of the index. And if name dropped out of the index, and CDS defaulted and you get the payout, what happened? You did not pay for the protection, yeah, but you received the upside. You did not have the same structure or the same profile of the trade if you trade single name against single name. But you do have if you move to the index. Because there is this survivorship bias which Alex did not talk but wanted to talk on, on one of the slides when he talked about the index. So through this construction, we effectively build short correlation trades from very high level, where money will be locked automatically and you don't pay on the financing side. That's what we at the time called JPM Centaurus. And because it has one head of the man and the body of the horse, because there are two sides to the trade, one is credit, one is equity. And that's literally what we done for converts, and that's what we offered as a solution for hedging long book and minimizing the regulatory capital of the banks at the time. You would be surprised, but at the time it also was a concern to minimize the regulatory capital. What we see here is that in quiet times, models work absolutely the same as basket of CDSs or equity leg. But in distress time, there is a decoupling. And this decoupling is where real economy kicks in. Everybody understands that S&P wall is not going to trade at 40 forever. You're going for longer term options, they will revert. Yeah? That's why equity wall never usually reacts the same way. And when we realized that difference in the blue line and the red line is really the free credit put, where you long jump to defaults, but you also long all the convexity, that's really where it becomes interesting business-wise. Because now we can do it in billion sizes. Yeah? Why in 2003, GP was derivative house of the year. It was mentioned there, and CEO of European part of the bank was talking to analysts about it and so on. Why? Because it's so scalable. It's a huge business decision. We already later in a different head with Fusion logo on it, we tried to do similar transaction with Barclays in 2006 with a large size talking to loan book guys. And at the time, they decided to go a different way and go through the structural credit route, where they securitize, they move away from the balance sheet and SPV, securitize their exposure and sell most of it. And effectively, it kicked back in 2007, 2008 when they had to recognize it back. But if you look how this thing would perform, it absolutely would do what it's supposed to do. So that the whole story which I told you was 2002, 2003, 2004, 2005. Is the relationship still there? Yes, it's still there. Yeah. We are in quiet environment, relatively. So when people say that there is a stress 2011, 2010, it's not stress. Really, it's not stress. If you talk to any credit guys in Europe, there are no defaults in Europe. Really, if you look at iTraxx main, the single default in the whole series in the history was a single default, and it was Parmalat, and it was a fraud. Yeah, it wasn't credit story, it was a fraud. So opportunity is there, and if you remember the previous talk, and you were there, that credit moves first, and there is now credit relatively more expensive to equity. That's what we're talking about. This is the bit. Yeah. You can follow it if you want to think about early warning signals. You can think about it in terms of building the trades if you want to do it yourself, or you can think about it in terms of if you're a bank, if you're an insurance company, Solvency II coming anyway, Basel III coming for the banks, you need to optimize your regulatory capital. These sort of trades, they can be done in huge size. And for me, models only successful when they come to a business development. Why Black-Scholes was so successful, and everybody knows Black-Scholes? Because it explained banks how to manage their risks. Not because it was a nice formula. Yeah? So this one, I believe, is interesting because it actually can explain how to manage your jump to default risk. How to switch from very name-specific risk to overall market risk, which is much easier to hedge and much easier to deal with. Yeah, I think that's the last one. Let me quickly go back to this diagram, which Alex spent some time on. So Alex went through this route. I tried to go through this route, statistical and credit models. Yeah. Spending another couple of minutes to combine everything together. So there is Merton, which tells you that it depends on spot. Yeah? There is credit risk reversal, which tells you it depends on vol and sort of on skew, how to link them all together. If you take credit risk reversal and push strikes very, very far, call will disappear, you will have your downside put. That's a standard CDS against the put trade which Alex talked about. Yeah? If you bring everything closer, yeah, to at the money where everything is tradable, there is a skew there, and at times at the money wall. At the money wall usually follows the skew. So spot dependence, which we always realized in Merton as a delta sensitivity, it's actually coming from the change of at the money wall along the skew. That's the hidden delta in the model. Yeah? And you can argue that on 5-year horizon it doesn't matter. Actually, it does. Yeah. That's how all models coming together if you start looking from the single consistent pricing framework.